ออนุญาตแนะนำนะคะดร.นาทีอมรสิริพานิชค่ะได้ดร.นาทีนะคะได้รับ PhD ในสาขา Financial Economics จาก Yale University แล้วก็ปัจจุบันนะคะเป็น Senior Financial Economist ที่ Federal Reserve Bank of Philadelphia ค่ะงานวิจัยของดร.นาทีนะคะมีทั้งทางด้าน Household Finance Real Estate Entrepreneurial Finance ค่ะแล้วก็งานวิจัยของดร.นาทีนะคะได้รับการตีพิมพ์ในวารสารวิชาการแล้วก็cover by major press outlet นะคะเช่น New York Times Financial Times NPR และ Bloomberg ค่ะสำหรับวันนี้นะคะหัวข้อสัมมนานะคะคือ The Age Gap in Mortgage Access ค่ะก็เรามีเวลาทั้งหมด1ชั่วโมงนะคะแต่ว่าถ้าเกิดมีคำถามระหว่างที่บรรยายนะคะก็สามารถยกมือถามได้นะคะทางบ้านก็สามารถกดถามได้ค่ะขอบคุณค่ะเชิญค่ะ
ขอบคุณครับขออนุญาตพูดเป็นภาษาอังกฤษนะครับ so I want to thank all the organizers for having me to present my work today. Since I'm from the Federal Reserve Bank of Philadelphia, the Fed disclaimers applies where the views in this paper are my views and not the views of the Federal Reserve. So the main question that I explore in this paper is what is the relationship between age and credit access? And from an academic perspective, this is quite important because, at least in the US, there's not a lot of research on this topic because there's surprisingly very little data that gives you credit access outcome for a big credit market, such as mortgages and applicant age on the right-hand side. So for those familiar with this literature, most of the work has been done on inequality with respect to race. And from a policy perspective, it's sort of quite interesting because one, obviously age is a protected class in US fair lending laws, much like race. But more importantly, as we all know in many countries, including the US, the population is aging very quickly. And so understanding this relationship sort of have important implications for policy making. In particular, if sort of age matters for credit access in a negative way, then presumably the transmission of monetary policy becomes less effective because there's some prior works that show that, let's say when monetary policy loosens, older people are less likely to, say, refinance their mortgage, but it remains an open question about why that's the case. So this paper sort of sheds some light on that. And then, of course, when we think about wealth accumulation, such as in the US, housing is sort of a big part of a household sort of balance sheet and the way in which they accumulate wealth. And so this demographic trend sort of, again, implies that now that, say, Gen Zs are having trouble getting their first home or getting their first homes much later in life. And so if there's this independent age effect, it also means that, wealth accumulation is slower as well. And then if more generally age matters for credit access, then, the quality of life in retirement sort of, if you need sort of credit, smooth consumption and the like, that also matters a lot. So the main motivation behind this paper is sort of, to sort of do a very similar exercise from the AER paper by Munell et al. In 1996, which is sort of like the seminal paper that basically uses the older version of this data to show that, look, even when we control for everything that's observable, there seems to be this gap in mortgage access between non-Hispanic white applicants and Black and Hispanic applicants. And then it sprung a large literature trying to explain why. And so this paper wants to do the same thing for age, just simply because, well, the data became available. So sort of interesting to look at. So what I do in this paper is to use a large data set of mortgage applications in the US to basically document just conditional correlations between age and rejection probability of the applications, and then conditional on getting the mortgage, what does the interest rate look like? And in case any of you have to sort of run to the next meeting, the finding is that age is positively correlated with higher rejection probability. So not just really old applicants, but like throughout sort of, so the age range is 18 to however old, we see an increasing, monotonically increasing probability of rejection. And then we also see the same pattern for coupon rates, so interest rates on the loan. And in this second part of the paper, I'm going to try to argue that the rejection probability results probably has to do with age-related mortality. So just having to do with, let's say, you trying to take out a long-term loan, much like mortgages, a 30-year loan, but your life expectancy is sort of shorter than that. And so that economically should matter. And then for the coupon rate result, I'm going to try to show some evidence that has to do with sort of insufficient shopping. So not shopping enough for competing offers. So the data set that I'm going to use in this paper, there are several data sets. So the first one is called the confidential home mortgage data set, which is an administrative data set in the US that its original goal was to sort of promote equal access to credit access, mostly with respect to race. But in 2018, they added sort of age and then other dimensions as well. And then the second data set is a national survey of mortgage originations, which sort of survey a representative sample of US mortgage holders about their mortgage access process. And here, this data set gives me sort of some evidence about the shopping channel. And then lastly, I'm going to use a merged data set between basically the first data set and a loan performance data set to sort of look at loan performance and its correlation with age. But then I guess I don't have the slides to that. I just realized I didn't include the slides here, so we'll see when we get to that. So the sample of mortgages I use here are single borrowers, first lien, single family, 30-year fixed rate mortgage. And here we call vanilla conforming loans because, as you may know, mortgages in the US, some small segments have sort of weird features such as interest only payments or balloon payments. So here we're just trying to take sort of the most simple and prevalent type of mortgage in the market to try to sort of do a better job of comparability. Of course, it's not perfect. And here, conforming mortgage in the context of the US means that mortgages that can be packaged and sold to the secondary market, and this is done by the GSEs, which are Fannie Mae and Freddie Mac. So the way this works is that lenders originate this mortgage and then sells the mortgage to the GSEs and pays a fee, which is which funds the GSE sort of insurance scheme of the MBS that it produces. So they take the pool mortgage and then issue a bunch of MBS, and this sort of creates liquidity in the US market. And that's like a sort of weird feature of the US market. But again, like because of the subsidy, it's by far the largest segment of mortgages, so around 90%. And so that's why, again, I chose to look at this part because whatever you document here sort of matters for like basically the whole market. So in the final sample, I'm going to have about 7.5 million mortgage applications. And then the survey is obviously very small, so about 9,000 mortgagees. And then the loan performance data is about 1.5 million mortgages. So I'm going to start with results from the rejection piece. So here, just following the literature, just going to run a very simple OLS linear regression where a rejection dummy is regressed onto age group dummy variables where applications are broken up in this way where 18 to 29 is the reference group and then the rest of the groups compares to that reference group. And then we have a vector of usual controls following the literature on so things like credit score, LTV, DTI, sort of following the literature on race. So in an attempt to control for observable difference in credit risk. And then here I'm also including other sort of demographics that's available as well, which are race, ethnicity, and gender. And then, of course, this regression gives you the conditional correlation between probability of rejection and applicant age. And of course, it suffers from omitted variable bias, but most paper in this literature uses this method. So this is where we're going to start. So this is showing basically the regression result from that equation. So if you look at column 1, let's see if I can. If you look at column 1, you can see that basically conditional on a bunch of stuff, right? Like demographics and application characteristics and a sort of standard set of fixed effects. So controlling for geography, time, and loan purpose here is whether you're buying a house or you're refinancing your home. You see this monotonically increasing pattern where as you get older, your rejection probability goes up. So the magnitude here this is 27 basis points. And so this one is 1.8%. And an unconditional rejection probability in the sample is about 5%. So this effect is economically large, especially if we look at this group, 70 plus, it's 3%. The US literature is obsessed with race, so it's helpful to compare with the race effect. So as you can see, it's like economically very similar. So it tells you that, in this naive regression, the age effect sort of really comparably large. So sort of from a policy perspective, it's sort of quite important. They do, yes.
Oh, so you
Yeah.
you can ask for age.
Yeah. So, right, it's going to come in a couple of slides, but yeah, I should talk about the regulation. But yes, they observe sort of many things about the applicants, but then by law, they can't use those characteristics as like the determining factors. Let's say they can't say like, oh, this person is 40 years old, I'm going to accept, as opposed to someone who's 30. So that's, yeah. And so here, I'm just adding more stuff, basically. This row here, I add lender fixed effect. So looking at within lender. So you might think that this pattern in column 1 is sort of partly caused by older applicants sorting to, let's say, more stringent lenders, right? For some reason, I don't know, like all the lenders in my neighborhood is really stringent. And this shows that this is not the case, because even within lenders, like fixing how stringent the lender is, you still find this effect. Columns 3 and 4 is mostly for the US audience, which basically does a simple exercise where what happens to the race coefficient if I drop the age coefficient, just to try to speak to the vast literature that came before this paper, and basically shows you that sort of whatever unobservable characteristics is causing the race and the age effect, they're sort of orthogonal, because if you switch them in and out, sort of the effects are very stable. And then lastly, in column 5, I changed the outcome variable to rejection, but not the actual rejection by the loan officer, but the rejection by the computer system. So in the US, and also in this new data set, in the US, for conforming loans, they sort of run the application through sort of standard automated underwriting systems to basically help out the loan officers. The system's going to tell you whether this loan is like eligible for you to originate and then sell to the GSEs or not. And so oftentimes we see in the data, the decision by the computer and the person is very different. And so in column 5, I replaced this actual rejection dummy with the AUS rejection, so the computer. And you see that the age pattern disappears, right? So this tells you that whatever is happening here has to do with the loan officer's information set. Now, it's like you shouldn't be interpreting this result as saying like, look, loan officers are like discriminating. It's just that when they underwrite the loan, they might be using more information than the computer, because the computer is just a standard software that looks at sort of general loan eligibility. So I'm gonna now explore some potential mechanisms. Yes.
Before you go to the mechanism, I think have you ever plot the credit risk of each of the age group of the applicants? Because as from seeing these, I think there seems to be a selection where 30 to 39 could be a better credit group, whereas if you are old and if you want to get access to home loan, I think credit risk might be in a different kind of group. And so, as the probability of younger ones who have better credit to start out with to access to this home loan, perhaps probability of getting credit would be better than the older one where they have bad credit history, credit risk, right? And if they have totally different distribution of credit risk for different age group, even though you already control for credit risk information, that's not enough, right? Because the impact of credit risk would be different across group. So I wonder, if that's the case, if you rerun separately for each group, like, or controlling for the, I think, credit risk multiplied by the age group, maybe could take that into account.
Well, I guess so. Yeah. So several questions in there. So I guess, of course, like controlling for credit risk here. So the variables here are credit score, DTI, LTV, and income. And so the usual way to control for these variables in sort of, at least in this US literature, is then you create like little cells. So I guess they're cubes now. So credit score by LTV by DTI, and then you include them basically as fixed effects. So this is controlling for like, even within this small cell, you still see this age effect. But you're right that like obviously this regression suffers from like selection effects, right? So to tell you about what the raw data looks like, we plot credit score with age actually goes up, right? Not surprisingly, right? Because it's like longer credit history, whatever. So if you just look at that alone, you would think that this is underestimating some, obviously it's driven by unobservable credit risk, right? But if you take the credit score plot at face value, then it's like, oh, wow, look, even older people have better credit scores, but then they're still facing higher credit risk. But then same thing with LTV. LTV goes lower. I think that has to do with like older people sort of downsizing. And then DTI is sort of slightly higher because of, income and old age and the like. So, but yeah, I mean, point taken, right? This is like much like try and document stylized facts about differences in race, but like, and to your point about interacting observable credit variable with age, I guess that's doable, but I guess for the purposes of regression, it sort of changes the interpretation, right? So it's sort of now it's comparing like different subgroups, and it's yeah. So just gonna explore a few mechanisms here. The first one is obviously Becker's taste-based discrimination. I'm just gonna do some simple indirect tests of these predictions. So obviously the prediction from Becker's work is that higher competition should lead to lower discrimination, just because if we think about race, if I'm a lender who's just particularly doesn't like Black applicants, so I'd require, let's say, like a higher hurdle for them. If I have a lot of competition, I can't afford to do that. So I have to sort of lessen my degree of discrimination. And then the second one is obviously like using some proxy of local age bias. Do we see sort of consistent pattern with, areas with more bias towards older people? Do we see a stronger effect? And then lastly, from the fintech literature, sort of, at least in the US literature, we believe that sort of fintech lenders use sort of standardized off-the-shelf models that doesn't consider demographic groups. So if we compare fintech lenders with banks, do we see sort of differential, sort of this age gradient? And so I'm testing these things in a very simple way. So the way this table is organized is that I'm omitting the standalone age term and I'm interacting the age terms with the interaction variables, which I have here. So for example, column 1 is the tracked HHI. So how concentrated are the lenders in each particular tract? And then the second column looks at the county level measure, because if you think the tract is too fine, then, just for robustness check. And of course, we don't see the pattern that we expect, right? So if it were, obviously, again, this regression is not identified in any sense, right? It's just correlations. So if sort of the taste discrimination channel is going on, we would expect that higher HHI tract will have a high, so the age gradient here would be positive and large, right? We don't see that, right? It's all negative, sort of random. And then here in column 3, I'm using like a measure of age bias from the political science literature. And this, again, higher values suggest higher bias. So we would expect, again, to see a sort of larger monotonically increasing this coefficients, but we don't see that here. And lastly, surprisingly, we look at fintech lenders, right? So this interaction variable is just a fintech lender dummy. So the reference group is traditional banks, right? Instead of seeing sort of a negative pattern, so increasingly negative, we see an increasing pattern. So it suggests, very, very suggestive, that like taste discrimination is sort of not driving the main results. Okay, so the second mechanism that I'm going to try to show some suggestive evidence that's happening is age-related mortality risk. So very simply, right, you're trying to take out a 30-year mortgage, but you're 70 years old. The loan officer would be concerned because he would be like, you can live for 10 years, so the bad loan to give. So in the US, the fair lending law sort of allows lenders to use age in this matter. So if they sort of underwrite loans in such a way that sort of thinks about age in terms of credit risk, that is sort of okay. So the prediction here follows sort of stylized facts about sort of mortality risk with age, right? So the number one, it should be the case that the marginal increase in rejection probability is larger for old age, right? So if I'm going to show a plot in the next slide, but intuitively, when you're really young, the probability that you'll die next year is very low. But when you're like really old, the next year you'll die, it's like really likely, right? So sort of each marginal jump should be larger when you're older. And then the second one, again, follows the fact that women live longer than men, especially the sort of probability of death sort of diverges really large, really a lot in old age. And so you should see this pattern when we interact sort of sex with age as well. And then lastly, what do I do here? Lastly, there's a small segment of the mortgage market that's non-conforming. So these are mortgages that if banks originate, they'll have to hold on to them because they can't sell to the GSEs. So you would expect the age effect to be larger there because now as a bank, I'm very concerned about this risk. So I can't put it elsewhere. And so you should expect that the age effect is sort of larger. Okay, so this slide just gets at the regulation that's relevant to this sort of discussion. Basically, this says this is the Equal Credit Opportunity Act is like the main regulation that governs, discrimination. And this first blurb basically says you can't discriminate according to demographics, so race, age, gender, marital status, right? But for age, they have this special clause which says that lenders may consider the terms of the credit extension if it exceeds the life expectancy of the applicant. And so this is sort of like suggestive. That's why we might expect to see this age-related mortality risk channel sort of comes through in the data. Okay, so again, to motivate the predictions that I told you about, this takes data from the statistical life data for the US, which is the data that the federal government uses to determine Social Security. And again, as I was saying, the marginal increase in probability of death in 1 year sort of increases exponentially as you get older, right? Not surprisingly. So, and the gap between male and female gets wider. And so that was what I was getting at. And so now I'm going to show the regression results, right? So here, this is the same regression that I showed you in slide number 1, but instead of regressing the outcome variable on age groups, right? I'm literally regressing on like each age dummy. So the reference group here is the same reference group, 18 to 29, but in this regression, there's a dummy variable for 30 years old, 31, and so on, because the data is so large and run this regression. And as you can see, right, it's sort of not exactly similar, but pretty similar, where the marginal increase when you're kind of young is sort of kind of low. Once you hit like this part, it increases really fast, even though the point estimate is sort of more noisier just because the data is thinner here, not surprisingly. If you run a regression testing the slope, of course, it's different. So this is, suggestive that sort of, this mechanism might be happening. And this is a similar regression, but now interacting the age dummy variables with a female dummy, right? And you have to sort of stare at this for 2 seconds because the picture I showed you is this, right? But these are all in levels. So that regression is basically picking up the difference here, like the gap. So you'd expect that in the regression, the gap is larger. And so right? And so the female dummy here would be negative, right? Because the gap is negative if you use male as the reference group. And this is exactly what you see here, right? That the gap, first, the female interaction term is almost always negative. And then the gap gets larger as you get older. And so again, it sort of nicely follows that. So again, very suggestive, but sort of, at least to me, sort of convincing that this is a driver of the pattern. And then lastly, same sort of interaction term exercise, but now it's the conforming loan, non-conforming dummy. So the reference group is conforming loans that can be sold to the GSE. So again, as a bank, I don't care as much what goes in, what goes out, because I'm not holding on to it. But then for non-conforming loans, banks seem to care a lot, right? And the coefficient is very large. Again, I was telling you that in the mortgage market, the unconditional rejection probability is 5%. So this tells you that, on top of the age effect alone, which I'm omitting here, you see this additional 6 to 7% rejection rate. So it's very large. So it's sort of suggestive that for banks, when it comes to loans that I can't sell, I really care about this age effect. And so it's sort of consistent with a risk channel, right? But again, of course, there's selection across conforming and non-conforming loans. And so that's sort of, biasing the coefficients. Other mechanisms that I don't explore here, one that I guess very interesting and sort of very sexy nowadays is there's this JF paper by my advisor, which thinks about how machine learning models might affect underwriting standards, but with respect to race. And so the paper basically concludes that if you have a model that you don't even input race into the model, you only input like credit score, DTI, whatever, and then input loan outcome, and let's say, and have the model like predict out of sample how you would do in these other new sample, you would still find that there's a large disparity between white applicants and black applicants just because of sort of this very systematic correlation in the data between race and sort of loan outcome and sort of observables, right? Because not surprisingly, like minorities in the US are sort of less well off, default so much more often and the like, right? And so a possible explanation for the age effect is the same thing. If you sort of in the data, you see that age is really strongly correlated with loan performance, then, sort of fintechs would sort of underwrite in this way as well. But I don't, explicitly explore this in the paper. And then lastly, this is sort of the boring one, which is the regressions I'm running are all descriptive and it's not sort of well identified. So this brings me to the second part of the paper. So now we're looking at interest rates. So the sample is now originated loans, right? A little bit of background. So I've been referring to this a lot. So conforming loans that can be sold to Fannie and Freddie follows this menu of essentially fees that lenders need to pay. And it's a grid of credit score and LTV. So, you can put loans in one of these cells. And this fee schedule is quoted as a percentage of loan amount. So when a lender, say, sells this kind of loan to the GSE and the loan is $100,000, they have to pay the equivalent of 1% of that to the GSEs. And the point is that the GSEs collect these fees so that they can guarantee the mortgages that they can sell to the market. And yeah, I said all that. So this matters because in this second regression that I'm running, I'm regressing coupon rates in basis points on basically the same age variables, same demographic variables, but now I have this month by matrix fixed effect. So this, again, is this matrix. Each loan falls into one of these cells, so I can, create dummy variables and put them in as fixed effects. So what this regression is basically doing is saying, comparing loans within each cell, do we see systematically different interest rate across age and demographics, right? And this follows a very famous but controversial JFE paper, which basically introduces this regression that says that, look, and the sample is all mortgages that were originated and sold to the GSE. So as a bank, I already know that I'm going to sell this thing. So the intuition being that if I know that I'm going to originate to sell, then the variation in interest rate should only be determined by this schedule, right? Anything beyond this schedule is like not about credit risk anymore. Because for me, it's like within this cell, then it fixes the credit risk and I'm paying this fee. So this fee should only be the only thing that determines interest rate in that cell. And so if for that JFE paper, well, of course they find that like still with this fixed effect, they find that Black applicants pay higher rates than white applicants. And so they say that like, look, that's discrimination because in this model of originate to sell, you shouldn't care about anything else. But turns out lenders do. So I'm using that same identification strategy here. Of course, like if you talk to many loan officers in the US, they'll say that, well, we don't really do that. We like put in more stuff, but that's another discussion. Right. So let's look at the results. So here, well, I already previewed this, so not surprisingly, right, we find the same increasing pattern. This outcome here is points adjusted coupon rates, meaning that I'm adjusting for it. In the US, you can buy mortgage points to lower your interest rate. So this sort of backs out how much points you bought. And you still see this increasing patterns despite more fixed effects you put in, right? Like within the same neighborhood, within the same lender, you still see this large effect. Large in this literature because this is basis points, right? So like the average interest rate during this time is about 3%. So this is like 8 basis points, and you say that's very tiny. It is, but in this literature, the black-white gap is about 10 basis points. So people are like, oh wow, that's really big. So it's through the lens of academics. So yeah, so if you sort of believe the identification strategy, then you would interpret this result as being like, look, the age effect that I document has nothing to do with sort of unobservable credit risk, right? Selection in that sense. Obviously, there's selection in other sense, meaning that which one of them I'm going to explore, which is like shopping behavior, right? So if shopping behavior, again, anything that's not captured by that grid is going to come in here. So here I'm just showing you like, what if I run the same regression with each age dummy, you find a smooth pattern again. So trying to make the point, not about mechanism this time, but about that, again, it's a sort of systematic pattern that for many people, it is surprising that even at sort of lower age levels, you still find this effect. Because most people looking at, like before showing them this plot, they would say that, look, you would expect like nothing, and then like a spike here, maybe because of retirement and the like. Again, I'm going to look at some tests for taste-based discrimination in the same way as the first part. And I'm going to tell you that doesn't seem to be going on. Maybe a little bit here, but then the pattern is not quite as monotonic. So it's sort of not super convincing. And then again, surprisingly, you see this fintech premium again. So much like the same conclusion, sort of maybe discrimination in the Becker sense is not driving this result. So I'm going to spend more time on insufficient shopping because at least in the US, there's a large literature showing that shopping really matters. It really matters for the rates that you get and the fees that you pay. Part of the reason why Black people pay more in the US because they don't shop enough. So it's intuitive to check for that in this data set. And some testable predictions is that shopping intensity decreases with age. So I'm going to look at like how many lenders do people consider as they get older. And then another thing I'm going to look at is origination charge. So this one is sort of indirect. It kind of shows that, well, if you don't shop very intensely, then you'll end up paying both very high interest rates and very high fees. And so you would expect to see the same patterns with age. So I'm going to start with the shopping behavior. This regression uses the survey data, and so the number of observations are very small. First two columns look at the probability that the person being surveyed considered applying to more than one lender. So haven't applied, just thought about applying to more than one lenders. And you see this monotonically decreasing probability as you age, right? And this is very large because I think in the sample, the unconditional probability is like 30%. So that's also a very surprising fact, right? It tells you that in the US, only 30% of people thought about shopping for, more lenders to get better rates. And you see that it correlates systematically with age. So now we look at people who actually applied. Same pattern, right? Not surprisingly. And the unconditional probability is even lower because not everyone who thought about applying for more than one lender has applied. So this is a large effect. And then lastly, the last two columns look at conditional on you applying to more than one lenders. Did you apply to more than one lenders because you want better terms? And again, surprisingly, it decreases with age. So people apply to more than one lenders for other reasons. And I ran this regression for other reasons that the survey provides. And the reasons are something like, oh, you know the lender before, so you were referred by your friend, and nothing else loads with age systematically like this. As in, like, it doesn't load the other way. So at least like data in the survey doesn't tell you why older people apply for more to more lenders. Here we just learned that, well, they're not looking for better terms. And hence this suggests that the coupon rate result is part of insufficient shopping. And then here, as I mentioned, the other thing that I could test is about origination charges. So here the outcome variable is origination charges as a percentage of loan amount in basis points. And whether I adjust for lender credit or not, I see the same pattern of increasing relationship monotonically. And so it sort of, again, suggests that it's consistent with the shopping story. Of course, again, not identified regression and some other thing could be going on, but together it sort of tells that the shopping story might be important. And lastly, a question you might have is whether insufficient shopping is caused by technology aversion. So maybe, in a stylized fact in the US is that fintech lending has increased dramatically after the financial crisis. So now the mortgage business is basically quite dominated by fintech. So things like Rocket Mortgage, and fintechs again in the US are you go online and you apply for everything online and then you get approval and the like. And you might think that older people are not shopping enough because, well, there's a bunch of fintech lender out there that don't want to use their internet. That doesn't seem to be the case because there's no correlation between the probability that you apply for your loan at a fintech. And so technology aversion doesn't seem to be, at least in this particular dimension, doesn't seem to be important. So again, other mechanisms that I didn't explore are sort of the same thing, omitted variable bias. If you don't buy the identifying assumption of that LLPA matrix regression, then we have sort of bias in the regression. And then an interesting recent paper shows that lenders also discriminate via menus. So this paper basically came out with a clever way to test whether Black applicants and white applicants get different menus of points and rates. So meaning that when the applicant goes to the lender and says, I want to buy points, how much is each point worth is different. And so that could be happening here with age as well. And I don't know, I have it here. And I guess one suggestive piece of evidence that this might be happening is that if I look at the baseline result, sorry, going back very far, but instead of points adjusted rate, I look at raw rates, the gradient is smaller. So it implies that one, older applicants are more likely to buy points. They buy more points, but also even after buying points, they get worse rates, right? So it sort of kind of gets at the menu question mechanism. So I think I'm going to conclude. So in this paper, I hope that I've convinced you that there's this very strong correlation between age and rejection probability, coupon rates, and fees, which implies that as you get older, for whatever reason, you face sort of higher barriers to credit access, at least in the mortgage space. And from a econometrics perspective, in this literature where it's very hard to identify things and most people run this kind of regressions, age seems to be an important variable to include. And then hopefully I've showed you that in terms of potential mechanisms, age-related mortality risk and insufficient shopping seems to matter. And in particular, the age-related mortality risk channel is sort of interesting from a policy perspective because it sort of explains this puzzle, at least in the US, that when monetary policy loosens, older people who own homes tend to very less likely refinance their homes. And that other data set doesn't see application. It's a macro paper, so you only see like sort of shares of refinances. And so this paper sort of suggests that, well, that might be because they cannot get access because of their age. And so we think into the future about when the US population really ages, you'll see that this particular channel of monetary policy might not work as well because basically the bank's going to say no to everyone. And then lastly, there's a lot of other mechanisms I haven't explored, so more work should be done on this topic. Thank you very much.
And we still have 15 minutes, so if you have any questions.
Thank you. So I think you are trying to relate it to age, but actually age also relates to other factors. And I think in this case, it's like shrinking working time horizon of people when they get older. And I think if you actually put in the net present value of future income of different people, it might take away the result that you,
of course, you
get.
Right. So yeah, so you can, that's definitely possible. And of course, you can think about other stories that, so like, if let's say, I guess easy example is that if you believe my mortality risk story, then if we go back to the main plot about rejection probability, suppose I observe the bank's mortality risk table, I put that in there, then the age is gone, right? So it's like
but I think there are two different things. Like like when
I take your point. I'm just trying to say like there's a
true.
number of variables that
Right.
potentially I can
Right.
put in the regression kills the age effect, right?
So what I'm saying is that it might not be the age itself that discriminated, but it's the like the life cycle pattern of people that discriminated. And in this case, you are getting like you're actually basically borrowing, you're getting a loan against your future income, and people get older, they have shorter income horizon, and that's just what explains the increase in the rejection rates.
Of course. But I guess, of course, I can't rule anything out, right? But I'll just bring up like an interesting point where if you look at this pattern, retirement age in the US starts, I guess you can start taking Social Security at 58 or something. And then, so this range, you don't see a jump, right? So in terms of like, I guess I'm trying to say like, if you're a lender and you really care about the PV of income, you should be very sensitive to sort of, you should be very sensitive to that cliff, if you will. But of course, again, not identified, just trying.
I mean, actually, at first, I tried to think about the retirement story, just like off comment. And I mean, because your mortgage is 30 years, right? So I think it doesn't necessarily have a cliff like at 60 years old, because the time that the one who apply for a loan still in employment is also linear in age, right? So I mean, if he apply at 40 years old, he have about like 20 years. So maybe 10 years after his retirement. So it could be like linearly. It doesn't have to be like a jump on. But I think on the other hand, I kind of buy your death rate story, because you have a gap right between like a male and female. Female have a lower death rate, so they have like lower gap. Maybe you can test something similar if you know the occupation, right? You know, like for example, government employees that have a like clear retirement age in comparison to like the business owner or self-employed. So you can test in these two groups. You maybe see the gap on that part.
I have to think about it, because in this data set, there's no occupation, but there might be a clever way to merge stuff in.
And the second point is when you mentioned with people in comment that about the control for the credit score, right? And you said like your coefficient should be like kind of underestimate because the older people have a higher credit score. But I think it's kind of the other way around, because if the older people have a higher credit score, but you already control for the credit score, right? So it's kind of like you compare the 30 years old with 60 years old with a similar credit score. So 30 years old who have the same credit score as the 60 years old should be on the higher side comparing to the 60 years old, right? So it even though we don't think about the mortality, it's kind of natural to see this result, right? I mean, the 30 years old who have similar credit score at the average 60 years old must be the one who on the higher end on his year, right?
Yeah, I think I might have gotten the direction wrong, but I guess the more important point is like about, like, I guess the deeper point that might be about the credit risk is that if you think about this result in sort of the classical life cycle model logic, then without bequest motives, you would think that, well, all the people who are applying are, just really bad. Just because you would think that in retirement, people don't want, in that model anyways, you don't want to take debt into retirement. And so all these people are basically negative selection into, so even if their credit scores are higher, it's like the unobservable is probably really bad.
It's can you go to slide number 22, please? So I noticed like a slight drop during the early ages, like between 30 to 40. So while I'm kind of convinced about your story, I believe there could be another mechanism working together. Like the age might not be the only mechanism that explains this, but maybe another mechanism is working concurrently. So I'm not sure if you have any way to explain like this kind of drop in the early age.
No, I don't, because well, I guess you bring up a really good point, and I guess I didn't do a good job at discussing maybe, but for both this plot and the first plot, right? It's like you think it's like to be naive to that there's one mechanism driving it. It's probably a combination of stuff, because especially with this piece, right? It's like, why would you expect gradual increase when you're young if it's like a purely age stuff? But I should say that this regression kills the mortality risk channel if you believe the identifying assumption, because again, if I'm a lender from a risk perspective, all I care about is this little cell, right? But I'm just using it for convenience, because obviously the main criticism of this paper is like, look, you're just running a bunch of OLS regression that's not identified, so we don't believe you. So this is my attempt to do a little bit of a better job. But of course, again, as I said, you ask loan officers, they would say that's not true.
Hi, I'm just curious. You have the data for the actual loan performance, right?
Yes.
Can you simply just do the track the actual loan performance against age and see that age actually contribute to more default, or
Sure.
later on?
So yeah, it is my bad, because I expected more questions, so I only had 30 slides. But in the paper, I have 2 tables on loan performance. So just a naive regression, default on age, controlling for a bunch of stuff, and then prepayment on age, controlling for a bunch of stuff. What you see is that default rate increases with age, not quite monotonically, sort of looks like this. But then prepayment, again, surprisingly decreases with age. I think that's surprising, because you would think that prepayment risk might be really high for old people, because let's say like they just take out a loan and they die, and then their estate pays for the loan, right? So it doesn't default, it gets prepaid. But then it turns out, at least in the data, it seems like young people are more likely to move around. I think that's causing the sort of difference in prepayment risk. But yet, back to your point, yes, you do see higher default rates. But I think the subtle point there is that it might explain this, right? But it sort of maybe not explain the first, sorry, it's very far. The first plot, just because it's like a different sample. So when you think about loan outcomes and sort of initial lending decisions, you have to get into this annoying literature about the infra-marginal selection, which I did not do in this paper. So yeah. So yeah, again, so right, it's suggestive, but yeah.
So basically, it makes sense, right? If we reject people by age, because it is proxy for the subsequent default risk.
Yeah.
So basically, age here is just a proxy for default risk.
Yeah. So that's part of the argument of sort of like default or prepayment having to do with your shorter lifespan, right? But I think the implication is sort of is not as sexy perhaps as discrimination, but it has sort of large implications for policy, right?
Just continue to that question. Just curious. So can you use that information to do like statistical discrimination under the current law?
Maybe. I think I might be able to do this same exercise as
if
like
you
the
see the
learning.
default rate increase with age, so
Mhm.
that people can, the loan officer is
Mhm.
legally can do that.
Yeah.
And another question related to Pin's question earlier on credit score, that you see the average increase with age. Do you see the variance is higher with age as well?
Oh, I did not check the variance, but it might probably is higher.
Yeah, so I think clearly for a given sale of the credit score, it might be useful, I think, at least for us to convince us that, it's the age, not the other unobserved things that correlate with age that drive this thing. Like if there are other data, like, I don't know, so mortality risk is one. You kind
Sorry?
of try to plot the mortality risk,
Uh-huh.
right? That's one. But yeah, the income generation thing is another one. Even asset for a given sale, and plot that other variable by age, and see if there are other variable that basically correlate with age that can contribute to extra credit risk that affect this. I think another big question is what's the policy implication? I mean, isn't it market-based to not lend to the long-term loan to the old people
Sure.
already?
Yep. So the policy implication is, let me go back. Well, the policy implication is, the refinancing channel, but also if you think about, also, I guess, home purchase, if you will. If you think about a model with bequest motives and like, how younger people in the US are having a hard time buying homes, if it's like the channel is like, oh, the parents are buying the home first and the like, and that's also getting harder with this channel, right? And I think it's mostly the interaction between this age effect and the demographic trends that's sort of interesting for policy. I think the age mortality risk channel is correct and not interesting in the sense of like, yes, as a loan officer, you probably should not make those loans. But the implication for, yes, as you think about what the US will look like, what the tools will central banks have in terms of like regulating the, the economy, if the trend continues, is, I think, interesting.
Because in that case, the fact that you have demand for credit, right? I mean, in theory, you have life cycle of mortgage loan. So you see clearly there's a hump going up and then all the way down when people retire. But if you look at the demand and you think aging is a critical thing and it creates more demand for older people, you might see different patterns just for the demand itself, not to the rejection rate, I think.
For sure. And I guess the deeper point is that the mortality risk mechanism should also be in play in other markets, right? And so to the extent, again, that people age and they use credit, that matters a lot, right? And I guess then it also, as you think about sort of changes in life expectancy having to do with technology and the like, that also, a bunch of implications for how you smooth consumption in old age, that too, right?
Okay, so we have reached the end of the seminar. If there's no more question, or if anyone in the room has more question, can continue the conversation with Dr. Nathi. So thank you very much for the presentation today, and thank you everyone for joining and asking questions. Okay, thank you.
Thank you very much.
Please.